Hello, welcome to Practice Problems for Homework 17. We're focused in this set of practice problems on pro forma projections, and in particular, we're going to be helping Eggs Everyday's CFO estimate next year's debt. She wants to know this because if the debt's going to go up a lot, she'll have to arrange for a new loan facility. If the debt's going to go down, she'll want to determine what debt they should pay down, that sort of thing. All right, so let's jump in. Today is the first day of 20X1. Historical financial statements and ratio analyses for Eggs Everyday are given below for the year 20X1. EED CFO believes that the firm's end-of-year cash level should be 5% of sales in the same year. That's very common, and that would be minimum safe level, 5%, very common. And the firm's goodwill will remain unimpaired. We haven't talked about that much, but we'll come back to it. Other parameters for 20X1 are as listed below. That would be down here. We'll get to that in a second. Given all this information, help the CFO determine whether the firm will be required to take on new debt in the year. Help her answer this question by projecting the below financial statements and solving for the debt. All right, so let's see what kind of parameters we got going here. So she believes that sales are going to grow by 20%. The firm is not going to pay any dividends, and the average depreciable life of their assets is 5 years. That makes sense for a commercial egg business, with the possible exception of their chicken coops, but maybe they're leasing their chicken coops, who knows. So that means that their depreciation is going to be 20% of net PPE at the beginning of the period. She believes their CapEx should be set at 150% of depreciation. That goes along with high growth here. So if you're growing, you got to buy more CapEx than you're depreciating. Safe cash level, okay, so she wants the cash to be not less than 5% of sales for the year. There's going to be no stock issuances or buybacks. The firm's interest rate is 6%, and she wants us to assume that's constant, and the tax rate is 30%. All right, so let's see what we've got here. So we have the historical roll forward equations and income statement and balance sheet. So this is the year that's just completed, EY 0, that was completed yesterday, and this is the year before that. So we have our PPE roll forward equation, then we have the income statement for last year, and we have our equity roll forward equation for last year. And we've got last year's balance sheet, everything on the balance sheet. So the debt has been held constant for the past 2 years. And here's our goodwill. We haven't talked about that before, but goodwill is what you get when you buy a whole firm, and it represents the premium that you paid over the GAAP value of equity for the firm. And there are several accounting rules for this, but the common one, the one that we're going to use, and the one that the CFO believes is appropriate, is that goodwill stays constant unless you have a reason to believe it's impaired, and she does not. So we're going to hold that constant. Okay, and then we have, I think, everything else we need. So we want to get started projecting. Basically what we want to do is we want to fill in everything over here for 20X1 that's already been done over here. And the way we're going to do that is for any quantity where we have a formula or a dictate from the CFO or from the board, like this would be a dictate from the board, for example. They're not going to issue any stock or have any buybacks, and this would be a dictate from the CFO. So whenever we have something like that, we're going to use it, and whenever we don't, we're going to assume that any quantity that we're looking at is going to remain a constant proportion of sales. So in other words, for something like Cogs, cost of goods sold, if it was 70% of sales in 20X0, we're going to assume, which it was, we're going to assume that in 20X1, it's also going to be 70% of 20X1 sales. Okay, so that's the way we're going to project everything. If we have an accounting rule or a dictate from the CFO or the board, we use it. Otherwise, we assume that the quantity projects as a constant percent of sales. Okay, so let's get going. So we'll start with our PPE roll forward equation. Okay, so the PPE net at the beginning of the period is always equal to whatever it was at the end of the last period. Okay, and for our depreciation, we know because we have that 5-year life there that the depreciation needs to be 20% of beginning of period net PPE. Okay, so I'm going to say take my 20% of my beginning of period net PPE there, and I'm going to get 17.6. And to be consistent with the way the CFO wrote this up last year and to have a nice correct algebraic sign convention, I'm going to make that a negative number. So far, so good for all of that. All right, so the CapEx here, they've also told us their strategy for CapEx. It should be 150% of depreciation. Okay, that again comes from, where did I get that from? I got that from what the CFO believes they need to spend there. So I'm going to say this is equal to minus this, whoops, times this, okay, and I get 26.4, and now the net PPE at the end of the period is beginning of period minus wear plus additions, so I just add all these up, and I get 96.8. Okay, and so in this case, we were solving for PPE at the end of the period. As you know, other CFOs might do this differently, and they might say something like, our PPE at the end of the period needs to wind up to be 100% of sales, and that would be fine. Then you'd know this, and you would know this, and you would know the depreciation. So in that case, you just solve for the CapEx. There's always going to be one thing in this roll forward equation you have to solve for, but you're going to know the other three things. Okay, so let's keep going here. Now we're ready to project the income statement. So sales, the CFO said she believes that sales are going to grow by 20%. So I want to say 1 plus this times the sales last year were 100. So she thinks they're going to have about 120 million in sales this year. Okay, so next up for Cogs, do we have an accounting formula for Cogs? No, I certainly haven't shown us one. Has the CFO told us anything about Cogs or the board? No. So this is going to be something that's going to project as a constant percent of sales. Okay, so last year I think you can see it's pretty obvious that if Cogs was 70 million and sales was 100 million, Cogs was 70% of sales. So that's what I want to have over here. So how did I get this 70%? I got this 70% by taking this 70 and dividing by the sales, and that gives me 70%. So in 20x1, I'm assuming that Cogs is again going to be 70% of whatever sales are in 20x1. So that's going to be 70% of 120, and that's about 84 million. Okay, depreciation, that sort of rings a bell. I look up here, and depreciation is in fact part of my PPE roll forward equation that happily I've already figured out for us. So this one is going to go per our roll forward equation, and I already have it computed from our roll forward equation. So here's my depreciation. And again, just to follow the sign convention on income statements where the expenses are represented as positive numbers, and we just know that they have to be subtracted from revenue, I'll make this depreciation a positive number. Okay, for SGA, we talked about SGA a bunch in the lecture for handout 17, and we really know that SGA shouldn't necessarily project as a percent of sales, but usually it's a relatively small percent of sales, and we don't have a good formula for it. So we're just going to go ahead and say that it projects as a percent of sales. So this will rigorously follow our rule that if we don't have an accounting formula or a dictate from the CFO or the board, we're just going to set it as percent of sales. So last year, SGA was 10, sales were 100, that was 10% of sales. That's where I got this 10% from. So now that's going to be 10% of 120 million in sales. I better get 12 out of that or I'm in big trouble. So let's see if I do. Whew, okay, so that looks good. All right, so now I'm ready to get my subtotal for EBIT here. So that's going to be my revenue minus everything else that's ahead of EBIT. Okay, and I get 6.4 for my EBIT, so I think that's looking good here. Okay, so for interest, that sort of rings a bell that she knows, the CFO knows the pre-tax interest rate for the firm, what it has been, and she's assuming it's not going to change during this next year. So that's going to be 6%, okay, and we've got the interest rate is, pre-tax interest rate is 6%. And we do know that to compute the interest rate going forward, it's going to be, to compute the interest expense, rather, going forward, it's going to be the interest rate times the beginning of period debt. So I'm going to take that interest rate and I'm going to find the beginning of period debt. Happily, I have a balance sheet for last year. Here's that beginning of period debt. And I think I nailed that one. So we have 1.2 million again in interest. And this qualitatively makes sense. If the debt hasn't changed and presumably the interest rate hasn't changed, we should have the same interest expense that we had last year. Okay. Always good to do these qualitative checks as we go. Okay. So tax, as we know, is always the tax rate times earnings before tax. And I think the CFO told us the income tax rate is 30%, and that's where I got that 30% from. Yep, there we go. She told us that the income tax rate was 30%, and we're using our usual assumption to say that taxable income on the tax return is almost the same as earnings before tax here on our income statement. Okay, so we want to take this 30% times, and what do I need? My earnings before tax is going to be my revenue minus every other stinking expense except tax. I got my EBIT, but I also need to subtract this guy. Okay, and I get 1.56, and now I'm ready to go to net income, which is just going to be my earnings before interest and tax minus my interest minus my tax. Oops. And yeah, I think that's good. So we have 3.64 million on 120 million in sales. That's not so good, but this is a commodity business, right? These big commercial farm egg businesses. So maybe makes sense. Okay, let's see what we've got here. Next up, we have our equity roll forward equations, that equity end of period is equal to equity beginning of period plus net income minus dividends plus paid in capital. Okay, and we've got here our equity beginning of period was 33 million, and we got that either from this existing roll forward or that better match what's on the balance sheet from assets minus liabilities, which it does. Whew, okay, so that's a good thing. All right, and then net income in the year is equal to our 3.64. Okay, board policy is no dividends, right? They say as a percent of net income payout ratio is 0. Okay, and they also said there are going to be no share buybacks or issuances of shares. So we know that that is 0, and now we can add all this up and get our equity at the end of the period, which is 36.64 million. Okay, now the fun begins, because now the balance sheet is where what we're trying to do is estimate for the CFO what's the debt going to be at the end of the year. is she going to have to anticipate taking out a new loan, issuing bonds, or can she pay off some of her debt, and then she'll have to decide what debt she wants to pay off. So let's start projecting things on the balance sheet. As far as the assets go here, we want to follow the CFO's view that the cash should not be less than 5% of sales. Okay, that's what she told us way up at the beginning here, and it's also listed again here. So we're going to go ahead and use that. So 5% of 20x1 sales is equal to what? Better be 120 still for the sales. It still is. So that gives us 6 million in cash. So that's really the minimum level of cash that she feels is going to be safe. Okay, so for accounts receivable, inventory, other current assets, we definitely didn't have a special accounting formula for those. The board hasn't said anything about those. CFO hasn't said anything about those. So all of these are going to project as a constant percent of sales. And in 20x0, remember sales were 100 million, AR was 15% of that, so we're going to project forward at 15% of sales. In 20x0, inventory was 35 million, sales were 100, so that meant inventory was 35% of sales. So we're going to say in 20x1, inventory is going to be 35% of that 120 million in 20x1 sales, and similarly for other current assets. Okay, so let's say this times, let me go up and grab these sales up here, my 120, and let's go ahead and lock that down, and I'm just going to paste these guys in. So 42 is 35% of 120, and 12 is 10% of 120, and that's looking pretty good. So that's all the current assets. So I can total up my current assets, and I get 78, so that looks good. And now to long-term assets, they only have one, makes it pretty simple. They're net PPE, and that sort of rings a bell. That comes out of an accounting formula, right? The PPE comes out of our PPE roll forward equation, so that 96.8 is what I want to put in there for that. Okay, so I'm going to say that's equal to, I could just type in 96.8, but I'll go ahead and point to it, and let's show that. Okay, and now we're ready to start on the liabilities. All right, so the liabilities for accounts payable, accrued liabilities, other current liabilities, definitely the CFO has not told us anything about that. We have no special accounting formulas for any of these things. So once again, we're going to assume that these project as a constant percent of sales. So AP was 40 million when sales was 100 million, that's 40%. So we assume in 20x1 that accounts payable is going to be 40% of 120. So I can say something like this, 40% times 120, or I could also be a little sneaky, which is what I'm going to do. I'm just going to copy these down and add up all my current liabilities. Okay, and I get 108 in current liabilities. Now we need to solve for the debt. So I'm going to show you how to do this in a couple of ways here. So the total liabilities, not including the debt. Oh, whoops, sorry. We're not quite done here. Let me fill these in. So we're going to solve for this debt. But again, the way goodwill works is that unless it's impaired, it's just held constant on the balance sheet forever. So I do want to go ahead and put that in, okay? And now total liabilities, if there was zero debt, if we went from 20 to 0, total liabilities would be equal to the sum of all these guys. Okay, and that would be 118. But I know a few things here. I know what my equity has to be at the end of the period from my equity roll forward equation. That has to be what my equity is at the end of the period. And whatever I get from the roll forward equation for equity at the end of the period, I better also get from assets minus liabilities equal equity, right? So I know this is correct, and let's see what happens when I get assets minus liabilities. So let me find my total assets up here. Whoops, I don't have them totaled yet, so first let me total those up. All right, so there's my total assets, 174.8, and that's in I-62. So I'm going to say equal I-62 minus my total liabilities are equal to, right now, 118. And that's clearly wrong. This has to be equal to 36.64. Okay, so the difference right now between these two is 20.16. But look, if I put in the correct amount of debt, which is 20.16, that's going to drive this number, 56.8, to be equal to this 36.64. Okay, so I'm just going to put this in. And now look at this. Now I've got the equity from assets minus liabilities equal equity is same to as equity from our roll forward equation here, and the difference is 0. So this is, in fact, the debt based on all the CFO's assumptions and the board's dictates and our assumptions that anything that hasn't been dictated to us is going to continue to grow as constant percent of sales in the year. Assuming all those things are true, then the debt that the CFO is going to wind up with is essentially equal to what she had last year. There are so many unknowns and assumptions built into what we did. I would say to the CFO, it looks like your debt is not going to have to change very much. I'd of course give her the numbers, but I'd explain there are so many unknowns in here that it's just hard to say that 160,000 is important. Okay, so now let's see how we would get this 20.16 by hand. Okay, so we know that we've got equity is equal to assets minus liabilities. Okay, and we also know that equity is equal to assets minus debt minus all other liabilities. Okay, and so then we have that debt is equal to assets minus equity minus all other liabilities. Okay, so let's see if we can figure this out here. So let's go back to how we would have been working this out by hand. We'd have a nice 0 in here. Okay, so our total assets would be, and let me do this so we can see all the numbers. So our total assets are 174.8. Okay, and now we need to subtract from that the equity, and we want the equity from the roll forward. That's what we've did way up here, what we did first. We know that has to be correct, so that's our 36.64. 36.64. Okay, and hold on, because it's just blocked out. That's not so good. That's looking a little better. Okay, so all right, so we have our 174.8 total assets minus equity minus all other liabilities. Okay, so all other liabilities, what I've got here with my 118 is I've got all the liabilities added up except for debt. Okay, so that's 118. So I'm going to put my 118 in there. Okay, and let's see what we get for that. Okay. And if we format that number properly, we get our 20.16, and then we just double check. And it's true, it's really true. If the debt is 20.16 million, then it's actually true that assets equal liabilities plus equity, and that also the equity in that matches our equity from our roll forward equation. So that's it. Pretty much with this type of thing, I could ask you to solve for cash, or I could ask you to solve for debt like we did here. And with things like the PPE roll forward equation, you're always going to know 3 out of the 4 things. So depending on the CFO's view and how she sets things up, you might have to solve for PPE net at the end of the period, or you might have to solve for CapEx, something like that. And in terms of the equity roll forward, it's really very mechanical. It's just going to depend on what the board says. The board might say, hey, we're going to have a capital raise of 10 million. Then you'd have to put that in there. That would be in addition to equity. And we know how to handle if the board says there are dividends. We know how to handle that sort of thing. Okay, so that's how it works. This problem is very, very similar to the one that you'll be doing in homework 17 and similar to something that you may see on the final exam. So that's it for now. Thank you as always for your time, and I'll be talking to you again soon.